are back on MorningLine again. This is actually our final segment. You know what? The hour when I spend it with you goes quickly because you're so full of energy.
Thank you.
You really are. Dr. Friday Burke's with us, tax preparer, tax expert, taking some of the calls. We've had several here this morning.
Awesome
Good
calls.
questions that
Great
you helped.
calls.
So if you want to jump in, you've got time, but there are some changes, things that you may be wondering about as you're preparing your taxes for this year. 737-7587. And waiting through the break with Sheila. So let's take her call next. Sheila, good morning.
Also known as a girl in Australia.
Morning.
Yeah, hey, that's right. Hi, Sheila.
Hey, how you doing?
Good. How can we help you?
I got a question about the Obamacare.
Okay.
We'll try.
We'll see what we can do on that if it relates to taxes.
What you got?
I worked a month. My husband is on disability, and they said that we still got to file. Do we still have to?
Okay, so how much did you make in a month?
I made $10 an hour. I've not got my tax papers yet.
But that's going to be, and your husband's on disability. Do you get Social Security?
Yes.
Okay, so the only income you have is disability, Social Security, and your 1 month W-2.
Yes.
No pensions, no IRAs, nothing else?
No, there's nothing else.
Okay, so here's the deal. You would not probably have to file. I would double check that with, again, I keep pushing VITA, which is probably crazy in some ways, but you know what? Big Sis is working for him this summer, so this tax season, so hey. This is exactly what they can do. They will tell you if you really have to, and it's free. You do not sound like you would have to file a tax return, okay, based on a quick interview here on TV, because disability is not taxable, Social Security is not taxable unless you have other earned income, and your W-2 does not sound like it's going to be more than $1,000 or so, which would make it zero. The only reason you might consider to file is if there is a number in box 2 of the W-2. That means they withheld some federal withholdings that you could put back in your pocket.
Okay.
But if it's only a couple pennies and if you have to pay for the taxes, it's not going to be worth it. If you can go someplace free and they physically do it for free, get the money, put it in your pocket, you'll do better with it than the government.
Okay. Well, what about the Obamacare?
How old are you?
I'm 55.
Okay. I think you're going to fall for the exclusion that it's unaffordable, because of the fact that you guys are on Social Security and disability. There is a waiver for that, and they should know about that. So I don't believe there's going to be any penalty because you really have no earned income to be penalized against.
Okay. And the insurance was so expensive, I couldn't afford it, so I had to drop it.
I have heard that so many times. So hopefully that is going to get some resolution in it. But answer your question for the tax standpoint, I think you're going to be fine if you chose not to file, but I would really get a second opinion on that. And there are some places you might be able to go, AARP or some of them that might have this kind of assistance that you might be able to get free.
Okay. Thank you.
Thank you.
Thank you, Sheila. It's going to be interesting. Obviously, you know, this Friday, Donald Trump will be sworn in, and there's questions about what's going to happen with Obamacare. And I think most Americans, and she's had issues, agree that if there is a change to Obamacare, they hope there's some kind of replacement. That's the idea, and that's the proof will be in the pudding here. Obviously,
if we could take the penalty off the table and make it more affordable, I'm not an expert. I would not even try to be that job, but the penalty has really, I don't think, has helped anything, because the people that are getting hit with a penalty are also 85% of them are the same people that can't really afford insurance. So the penalty has not really done anything for anybody, but now they owe the government more money. So now I've got people that have higher tax issues that they can't afford. Now there's no interest or penalty, there's no penalty that can be assessed against the shared responsibility. So if you don't pay it, there's no penalty. The IRS cannot come after you for collections, but they can charge you interest. And eventually they can get it, or you wait 10 years and it will fall off.
It'll be interesting to see how that plays out with the Affordable Care Act. Just one other thing, too. I don't want to get political here, but with Donald Trump coming in and a new administration, do you anticipate him and the Republicans who are in charge, maybe you heard him talk about taxes and things like this. I mean, we don't know what he may bring to the tax code, but what are you looking at there that you may anticipate changes?
I'm hoping that he simplifies the fact. Now, he wants to eliminate the 10%, go back to 15, 20, and 25. Lower the top, lower the bottom. But what's best about his plan, and he does have, if you want to go to donaldtrump.com or whatever, there's a tax plan on there. The biggest thing is more benefits for the middle class, taking a little bit from the people that maybe get too many credits. We seem the tendency to pay people for having children, and then a little bit from the top, charging a little bit more on the top, but giving more credit. So people that are making 65 to 120 as a married couple that are really struggling, to give them a little bit more money, keep it in the 15% tax bracket instead of kicking some of that into the higher bracket. We give them more money to spend, which means they'll go out, spend it in the market, and then we'll actually get it back through sales tax and other things. So it's a way of helping them out.
That's one of the things, and we'll see if something like that passes, but the concept. All right, let's go back to the phone lines. We'll go to Marcus. Marcus, good morning.
Good morning, Nick. How you doing, Dr. Friday?
Awesome, thank you.
I got a question. I'm a veteran. I go to VA. Do I have to require to have health insurance?
VA automatically gives you health insurance, and thank you for serving. Appreciate all the service you've done. And if you're living off any VA benefits, those are not taxable. So just as a point of interest, you may be working and doing other things, but the VA does have their own health insurance, and you should automatically be qualified and should have no penalty as long as you had it.
I think he just wanted to check. He hung up, but I think you answered his question on that. No, he's still listening, so he doesn't have to. That's where it gets confusing, and a lot of people worried about getting that statement in the mail that's going to be sent out in the next few weeks about whether or not you owe money because you didn't have insurance.
I'm not even sure if the VA sends out statements because I'm working off memory a little bit, but it seems like in those cases they have VA cards, but I don't think we actually get any statement from the VA.
Okay. If you would, and again, the line's open and we just have a few moments remaining, but if you have a question, you can jump in. We've had a lot of great calls this morning. In your experience, what are the main mistakes most people make when they're preparing their own or when they bring things to you to be prepared that they don't bring with them? What would you say?
Claiming themselves, as the young lady that called and said, I was married only less than half the year. So those individuals that may not have called, she might have normally filed as head of household, maybe she had a child, so she might have filed as head of household in the year in which she was married, which would have been wrong, because in that case she might have got a larger refund than when she's married and claims her child. So the IRS, that's a mistake people make, right? So you don't want to, if you are married, you have two choices, married, filing separately. If you are single, you may be single or head of household depending on the situation. You can't be married and head of household. That's not an option.
I see. Okay.
Second option is claiming children. Just because you gave birth to a child or that you're the father of a child does not mean you're entitled to claiming that child. It may not be claimed by either of the parents. It may be that a grandparent or someone else.
It's where the child is living and who's caring for that child is the way it should be.
It is the way it is, because when it comes to us proving it under an audit situation, if the child is living with the grandparents and they can prove that they have been there for more than 6 months and 1 day through medical records, educational records, the address on everything they have is coming to grandma and grandpa, you're going to have a very difficult time proving that that is not your child unless you happen to be living in that same household. So just making sure the right person, because we have quite a few cases, probably about 6 or 7 cases right now where we're basically representing the proper parent, and that means not only are you going to get hit with the IRS coming back changing your taxes, but guess what? They can kick you out of the earned income credits. So you may never be able to get those credits in the future when you might legally be entitled to do that. So it is an honor to be able to claim it, I guess is the proper word, whatever. You don't always have it. So be careful of what you do. The government can take your money.
Gotcha. A couple real quick questions here as we wrap things up if we don't get more calls. One, does it make any sense to you if you think you're going to owe taxes at the end instead of getting a return, what about not claiming anything, putting a big fat 0 down on your tax forms so nothing's withheld, and so, or no, you don't get any benefit, and then maybe you pay more? Could that help in any way reduce what you're going to owe instead of getting hit in the face with some big bill at the end of the year?
Well, especially when someone's married to someone that's self-employed possibly is a great way. I often have the person that works, quote, a real job, a W-2 where there's withholding. Even though they may be married with 3 children, I might have that person claiming single and 0 so that way when the income gets combined on the tax return, the other one's not paying as much of the quarterly estimates. It comes out in the wash, right? It's all in the family. But if you owe the IRS, I would not suggest doing that necessarily. necessarily. I would necessarily say, let's set up a payment plan that you can afford and still paying enough where you actually, the refund is going to go back to pay any debt you have anyways. But it may be easier to actually set up a budget and then not have big refunds. I don't like big refunds.
Okay, and one other question with regard to investments, and I know Hank Parrott, your buddy, would talk a little bit about this, but anyway, yeah, I'm thinking about retirement, and you have, well, I don't know what he would say on this, but you have a 401k.
Yes.
And you have a Roth.
Okay.
Okay. Is it wise, I think, to have a fund in the Roth so when the time comes and I'm retired and I draw something out of my 401k, I may draw enough, but just enough to where I get to the threshold where it would take me to the next level. Let's say I need enough money and the amount I want would push me into another tax bracket.
Right.
But instead I take the 401k right up to that point, and then I take the rest out of my Roth that I need, which is already tax-free. And that keeps me under. Does that make sense?
Well, the question is, are you at a lower tax bracket when you're playing that game versus right now when you're at the highest tax bracket and you can defer all of the 401k to give you more money in your pocket today? So, in essence, let's say right now you're at the 25% tax bracket. So every dollar you defer into your 401k is saving you 25% on your taxes. Then when you retire, you're at the 15% tax bracket.
Right.
You're only going to pay 15% on what comes out of the 401k
because I'm making less
instead
now.
of the 25% that you'd be paying today. So to me, from the tax numbers, I would say you have to really look at, if you're 15% today and 15% probably when you retire, that answer would be, yeah, why not defer? It's going to be versus the same amount. But if you're at a higher bracket, defer the heck out of it. Put as much into your 401k, not your Roth, your 401k, because you are going to drop down most likely into a lower tax bracket. And remember, Social Security can only be taxed at 85% of it, not 100. So you would then have only a 15% tax on the money versus right now you'd be paying 25% tax on that same money.
So the advantage to the Roth, having the Roth there to balance, what would that be in your mind?
In my opinion, if you're, it's really only advantages for people that are not in the higher tax brackets. If you have a Roth in the higher tax brackets, you're basically funding something with the idea that you're going to be in the same high tax bracket when you retire. All the things considered, hopefully that's not the case, because hopefully you pay off your home and all that, so you don't need as much to live on when you're retired.
Unless you're still working when you retire.
Well, that's a whole different concept.
Yeah, that's a whole different concept.
Yeah.
That is interesting. Okay, because I've got both.
I know. I know.
Well, you're
trying to play keep all the balls in the air and play it all.
It makes no sense, but I just love the idea that when I go to, because I've heard plenty of people who have retired, and they're saying when they draw on their 401k, they're getting taxed more than they thought they would, and it's hitting them in the chops.
Yeah.
Whereas with the Roth, which I don't have as much in the Roth as the 401k, you put in the money and it's after it's been taxed, and then it grows. But whatever it grows to, when I take out my Roth, barring the lawmakers changing this, in which case I'll vote their butts out, I get that money. If I get $50 out of my Roth, I get it.
$50.
It's $50.
Yes.
Whereas if I get $50 out of my 401k, I'm maybe getting 42. I don't know.
Exactly. That's exactly right. But it did grow with the IRS money in it. This one grew with the IRS
and
not
it's
in it.
pre-tax dollars.
So, you pre and after. But I think it's a balancing game. But I just think a lot of times people have a tendency to think about what they could be doing in the retirement. And hopefully in retirement we have you in a lower tax bracket.
Gotcha.
In your case.
Dr. Friday, how can people reach you? Not that you need the business because you're too damn busy. Okay,
so if you want to set up an appointment, the easiest way to do that would be go to the website, drfriday.com, click on appointment, and set up your tax appointment. If you need to call me, 615-367-0819, 615-367-0819.
And we'll get a graphic made for that because I understand you're going to be coming on every month between now and tax day.
That's what I'm told.
I think you're up, what'd you say, February, Valentine's Day?
I heard something like that. Oh, wow.
I would like a little heart-shaped cookie on that day.
Would you?
Frosted.
Oh, no, sugar's not good for you. You'd be too hyper, God forbid.
I've already had some candy bars for breakfast.
That kind of explains it, doesn't it?
You and I both have a lot of it. Nice seeing you, ma'am.
You too. Thanks.
We'll see you again soon. Be back with a programming note right after this.